Stock markets come down for a second consecutive day. Does that mean anything? That's what we're going to explore here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And it's been an interesting sort of week in the wake of last week's Fed policy announcement. Markets seemingly trying to find their way and looking across assets, things kind of sliding in new and interesting directions, seemingly without any kind of rhyme or reason across markets. It's very difficult to thread a macro narrative here with what's going on, but we are certainly going to try. And that's where we'll start things off. We'll just look at how markets were performing today, what we have so far this week, how that lines up with where we were last week, and a little bit on the macro news flow that we've already seen this week, because it has been significant and it has been telling us a story. So, looking at first the S&P and NASDAQ here, of course, just for today, off about 1/3% apiece. And interestingly, yields higher. So there is perhaps some semblance of rhyme and reason here starting to develop. So the longer end of the curve a little bit stronger, 10-year up 1%, 2-year up 0.5%. Crude oil still doing its own thing, not really paying attention to what's going on elsewhere and oscillating in familiar territory. There's about a 54 to 74 range in crude that has held for months and months and months. And now we're kind of looking at prices testing the upper part of that range, but not really going anywhere beyond it. The center line for that range, right around 62, and the internals of that range around 65. So markets have been essentially oscillating between about the low at 60, 80, 61, and up to as high as 65, basically going back to early August. Haven't really gone anywhere, but broader terms, this center line around 62 has been in place at least since early April, and we've kind of oscillated around that with lows in April, of course, as we have for most risky assets, around 54, highs around 73, 50, 74 in late June, and then just oscillating in that space without really finding a clear connection with the broader narrative. Gold, however, with a spirited sell-off today, down 1.25%. Dollar also uniformly stronger across the board, up 0.6% against the euro, almost 9/10 rather, almost a full percentage point, in fact, against the yen. Bitcoin, interestingly, higher, 2.4%, but that's not really telling us a story about sort of overall strength, because, of course, Bitcoin has been down for 3 days into this little bounce and is just kind of retesting a little bit, but doesn't look like it's really putting on a convincing reversal of those earlier losses. And indeed, if we look at how the markets have performed cumulatively so far this week, stocks down, but about 0.4%, a little bit less on the S&P, about 0.5% on NASDAQ, yields up. So that part of the story seems to be holding. Gold still net up on the week, although, of course, much more narrowly so after today's sell-off. Dollar up, although, again, more narrowly than just today. Euro down, yen down. Bitcoin, on the whole, still down for the week. So if we compare here, while gold is down today but up on the week, Bitcoin is up today but down on the week. So a little bit of jostling there. But on the whole, what we seem to see here is perhaps a little bit of a hangover after last week's Fed policy announcement. The Fed, as we've discussed here before, came out less dovish than expected, or at least than the markets wanted. And we can see that in this summary of economic projections. As we've noted before, we have expectations for GDP upgraded across the forecast, expectations for the unemployment rate downgraded, inflation adjusted higher, at least for next year. And when we look at these policy expectations, we can see that now the Fed in September had 3 rate cuts narrowly on the menu, as opposed to 2. The starting line was 4.4. So June's projection was down to 3.9. That's 50 basis points. This projection in September was down to 3.6. That's 3 cuts. That largely already existed as a forecast in the markets. So we were looking at the likelihood that we'd have a October rate cut already very much on the menu when the Fed came out. And of course, now it's very strong indeed at about 91, almost 92%. But even a week ago, going into the Fed, we were looking at 87%. So it's not like there's been a violent shift here. The markets knew that this October cut was probably going to happen. And then in December's meeting forecast, now we're looking at a 75% chance that we're going to get that third cut. A week ago, it was a little bit stronger even at 81%, and that's going into the Fed meeting. So it's not like the markets didn't know. It's not like the markets weren't already priced for 3 cuts this year. They already had those probabilities very firmly established. So the Fed didn't really tell them anything that wasn't already in the market. But if we look at what then happens thereafter, still only 1 rate cut on the menu for next year and the year after. And of course, as we've said, this continues to be a potent disconnect with markets, even though they've started to kind of go the Fed's way here a little bit. Markets still see 63 basis points in rate cuts next year. That's obviously at least 50, and 13 basis points in the direction of a third cut. And if we do the math here and what this ends up looking like, it's a 52% chance that we get that third cut next year. So we're kind of hovering at the dividing line. The likelihood of that third cut next year has come down a little bit, but nevertheless, it's not 1 cut. It's well in excess of that. And so as we look at what's going on here, we can see this year has anchored nicely around 35 basis points, so that's at least 1 cut, and then showing us the likelihood of the third one. And for next year, there's still this disparity. Nevertheless, the markets are starting to claw back some of this easing. We can see we're narrowly down to about 100 basis points, just under, in rate cuts cumulatively, whereas going into the Fed before this 25 basis point adjustment right here, we had 140 basis points on the menu. So take that 140, subtract from it the 25 basis points that we just got, and what you end up with is 115 basis points, whereas the market is now at 98. So there's a little bit more here than just taking away a rate cut that's already occurred. Now we're looking at maybe the markets are starting to embrace this idea that the Fed wants to run the economy hot and address the weakness in the labor market that it perceives that way. And one of the more interesting kind of ways to read this, of course, comes once again from Fed Chair Powell. He spoke just earlier this week The comments, not exactly anything that you might not have anticipated, having heard what he said at the FOMC announcement itself. But what we see here is interesting in the sense that it really distills the Fed's argument here, saying, look, there's no risk-free path. We're not ignoring that inflation is there and rising, and as of the last CPI numbers hit a 70 or a 7-month high. So the Fed is very clearly acknowledging here that, look, it's not like we're saying that inflation is solved and that's why we're cutting rates. We're saying the risks to the labor market have increased, and so the balance between the trade-off of containing inflation and underpinning the labor market, that balance has shifted. And that's what has prompted this cut. We can see also that on the inflation front, Powell is making the argument that goods price increases largely reflect tariffs as opposed to something more entrenched, and that it's a reasonable base case that this tariff-driven inflation will be short-lived once the one-off price adjustment is basically absorbed into year-on-year calculations and rebased. In the Q&A after this speech, we can see that the Fed wants to focus on a more balanced approach as opposed to just inflation. A couple interesting tidbits here is that we see the Fed saying maybe what's happening in the labor market is part of how businesses are dealing with the tariffs, because of course we see that the tariff pass through, according to the Fed chair, has come later and has been less than expected, and that is something we've talked about here quite a bit. This idea that wholesalers were eating tariff costs on behalf of consumers because they didn't want to destroy demand by raising prices, but that this process has arguably ended at this point. That now we're getting that pass through, and wholesalers' margins have started to expand again, as we saw most recently in the PPI data for September. So as we look at this, then, we get to a place where the Fed's argument is, okay, we've had businesses shoulder these tariffs. Maybe they're not hiring because that's where the firepower has gone. The spend has gone toward managing these tariffs, and that's why businesses don't want to be expanding staffing. Nevertheless, the Fed thinks this is going to be a one-off pass through, to some extent, famous last words. We'll see how this goes. But one argument going in the Fed's favor here in kind of focusing on the labor market and considering inflation something that they can not de-emphasize, but balance a little bit less heavily against needing to work to underpin the labor market was the S&P Global PMI report this week. We can see the composite index showing us we still have growth, of course, as ever. PMIs are centered around a 50 line, where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So you do have growth here, obviously. Here is the 50 line down here, and this was the latest reading. So we're well above 50. The economy is growing. But we can see here that over the course of July, August, and September, the pace of economic activity has slowed. And it's not just on one side or the other, it's both. So here's manufacturing. This is where, of course, tariffs are most acutely felt. We can see that there is a pullback here and a slowdown there, albeit a more modest one than what we see in services, where there is this thing echoing the composite index and a third month of slowdown there. So maybe the economy is, in fact, starting to come down a little bit. This data, of course, was early to speak about the reflation from an economy that was reheating as early as May. So we can see that we got this buoyancy here that we didn't really get in a lot of other measures. This is why this S&P data is so good. It's quite early, usually. We got this for the composite index. Now maybe we're starting to come off a little bit. Maybe this is speaking to the Fed's sort of relatively benign view of where inflation is heading, and perhaps even to some extent endorsing what the markets are suggesting, because one of the more interesting parts of this is that with slowing activity, you've also seen a little bit of a downtick on the price front, but for inputs into services. So you can see here, especially where the tariffs are the most acutely seen on the manufacturing side, costs have edged lower. And you can see that as far as output prices go, they've edged lower for both services and for manufacturing. So if you look at the composite here, we can see overall the price structure is getting less inflationary here. Again, we're still very much in positive territory, so we're well above 50 on the overall index for composite prices, but clearly the pace of inflation has slowed here. So maybe that's helping to endorse what the Fed has done here. Now, where this gets interesting is, of course, when we start looking at the relationship between what's going on with the policy outlook, since this has been the driver of momentum recently, and we see what stocks are doing. Here is this sort of baby pullback this week. That's this right here. But we can see that there's not really a strong level of consistency. So whereas at the beginning of the year, it was clear, sort of here is the near-term range. Here is where we broke that range. You can see here at the same time is where you get the start of a dovish move in policy expectations. Then, of course, in early April, that move finds a bottom. And it makes sense that these policy expectations move at the same time as stocks do, because this ends up being a growth scare. It ends up being a conversation about, oh, well, the rollout of these tariffs is going to hurt growth. Business and consumer confidence are down. And indeed, the PMIs were some of the earlier indicators. And then, of course, we rebounded once sentiment steadied, and it looked like the White House was going to be amenable to market discipline of this variety, where stocks go down and bonds go down and the dollar goes down all at the same time. And so sentiment starts to recover, but notice where the policy outlook actually lands. Stocks ultimately rebound and the growth scare fades as you get this rebound in the policy outlook, but it stops well short of what happens with stocks. Stocks come back basically to where the breakout was right here. That's where the end of the unwind of dovish expectations is in Fed funds futures. From there, things only get more dovish. So even as this year's outlook anchors around sort of a center line of 50 basis points and cuts, sort of right around here, the outlook for next year starts to get more and more dovish. And the rest of this build out in stocks seems to come at the same time as you get the promise of cheap money getting louder and louder and louder. Then you get this move. And at first we can see stocks are happy, even though we have this larger than just a 25 basis point adjustment and things get a little bit less dovish, stocks still find a way to love this. And we've posited that that's because they're betting that the Fed's going to run the economy hot. But now, perhaps, things are getting a little bit soggy. So maybe we've reached a level where the money is now getting uncomfortably less cheap. We're going to have to see how this goes because, of course, this is just a blip on the radar so far. For the dollar, though, this does make a lot more sense. The dollar seems to find a bottom here where it last tested in lower in early July, and as things get less dovish, so too the dollar seems to be finding impetus for some kind of a low setting. This seems to be working as you might expect. When things get more dovish, the dollar falls. When things stop getting more dovish, the dollar starts to bottom. So fairly straightforward here. Now, as far as exposure goes, I'm still looking for that dollar rebound to continue, so I'm still short the Aussie, short the pound, short the euro, short the Canadian dollar. I've taken off my gold long position, which I held for the better part of 2 months. It seemed to have hit some kind of a roadblock today, and that was coming up on expiration, so why not take some profits? And I'm still long silver because this actually did not have a meaningful move down today. It's a little bit soggier here, we can see, but it hasn't really taken out its digestion range, and so I'm still long the precious metals there. I've started to nibble a little bit on the short side of the S&P through a put vertical on SPY here. Certainly not looking for any kind of Armageddon-like scenario, but after 2 days of selling, it does seem like while the vol is cheap, in the event that this is the real deal, then maybe take a little stab here with better than 2-to-1 risk reward, and still a little bit long the bonds, looking for this to bounce a little bit. It started to go in this direction a little bit, and so this is maybe the beginning of something, but we'll have to wait and find out. It's still early days yet. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise writing for the News and Insights portion of Tasty Live and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. In the meantime, happy trading.